In this video you will find the most comprehensive overview of the stochastic oscillator. We will cover its structure, signals and compatibility with the other instruments. Moreover, we will test stochastic trading strategies in practice. Firstly, let's begin with answering the question, what is a stochastic oscillator? So, this oscillator is a technical analysis indicator that reflects the dynamic changes between the bar's current closing price and price extremes for a given period. So the instrument's primary function is to determine market patterns such as, for example, local extremes, the beginning and end of a trend, convergence and divergence, the beginning of a correction. And so the premise of a stochastic oscillator is that the closing price stays at the previous local maximum for a while in the bullish trend and stops at the level of prior minimums in a bearish trend. So, the stochastic oscillator formula is publicly considered effective when it is used on a 1-minute time frame as well as an hourly, daily or weekly time frames. But if you ask me, I always lean towards higher time frames and never use anything on time frames lower than M30 or even H1 since there is too much manipulation and noise on lower time frames. So, let's say a few words now about the history of the indicator. The stochastic was invented in 1950 by American stock analyst George Lane. So, once while observing the price changes, he noticed that there was not a trend but a reciprocating movement that prevailed on the market. So he developed an indicator that would catch these dynamics and signal reversals in both directions. And so, the stochastic indicator was based on the price bar's major parameters, the closing, high and low prices. So according to one of the theories, there were initially different types of the stochastic oscillator formula. Combinations of price bar parameters and their derivatives were sorted out to determine naturally the best one. So each formula was named by sequential letters of the Latin alphabet, percentage A, percentage B, percentage C, etc. However, only two options, percentage K and percentage R, were successful. So a combination of the stochastic indicator percentage K and its moving average named D, from the word deviation, became the best option that can spot when the asset is overbought or oversold. Technically, D isn't a stochastic, it is a derivative from percentage K. However, it is called stochastic and even has a percentage symbol. So there you go, this is how the well-known stochastic oscillator was created. At the same time, the percentage R did not disappear. It can be found under the name percentage R Larry Williams oscillator or simply R Williams. Okay, next we will go through the mechanics, i.e. basically how it actually works. Classically, a stochastic as a technical analysis tool is represented by two moving curves that move between two levels. Usually there are 80% and 20%. So the solid orange line in the image is called percentage K and the blue line is the 3-period moving average of the percentage K curve. So when two lines are above the upper level of 80%, marked with the blue zones at the top, the instrument is overbought. When they fall below the bottom horizontal line of 20%, which is the red zones and in the bottom, it's considered oversold. So this is how the user can easily spot the overbought and oversold levels on the market. Line crosses have a special meaning. If it happens in the overbought zone, it's a signal of a short position. If it happens in the oversold area, you should open a long trade. Nevertheless, as with any trader magic tool, it's not recommended to trade using only the stochastic oscillator. So since even in the simplest strategy with the stochastic, signals are filtered by the trend direction. So for instance, if a downtrend prevails, open only short positions. You know the drill. You wouldn't try to trade in the opposite direction to the prevailing movement on the market. So naturally, if there is an upward trend, place only long trades. And yeah, combining a stochastic indicator with the other trading tools can help the user to spot easier overbought and oversold conditions. Thus, if we analyze the overbought and oversold levels of this Euro-USD chart, we can spot a bearish trend. That's why we look for a point to open a short trade in the overbought zones. And so the stochastic oscillator represents a potential entry point where the red oval is, as there is a crossover, of course, of the indicator line above the 80% line. So a short-term correction should end and the downtrend should continue, pushing the oversold levels lower. Next, let's discuss the SMI, the Stochastic Momentum Index. Because maybe you didn't know that, but in addition to the classic stochastic indicator, a modified version called the Stochastic Momentum Index Indicator, or SMI as I said, is also widely used, and it is also considered a very efficient technical analysis tool that combines the mentioned tool with the momentum, which provides smoother signals and is less dependent on market noise, which means it should be rather more efficient in lower timeframes, since there is much more illogical moves over there than in higher timeframes, where this kind of smoothing will simply delay the signals instead of helping, because on higher intervals you don't see those spikes. In SMI, curves are built around a zero line and move in either a positive or negative direction. One of the curves are called smoothed or fast, another one is short term. As you can guess, these lines differ by period. Some of the stochastic momentum indicator's pros are its reliable entry and exit signals when the market is flat. Still, even in such a case, it's worth using the SMI with other technical tools, because the SMI uses the last closing price and provides plenty of fake signals. As for downloading it, I saw a couple of versions of it on TradingView in the community section, but if you want to use it on MetaTrader, there are also a couple versions, but for MetaTrader 5 on MQL community website. So let's switch to some examples. If both the main and signal curves, the green and red line in the chart, are above the zero line, which is the blue one, the market is overbought. If below, the market is oversold. This way, the user can always have a better understanding of the overbought and oversold levels of the market. A sell signal is formed when the main momentum indicator line crosses the signal line upside down. So the red arrow marks this moment. If the stochastic indicator breaks the signal line bottom up, which is the green arrow, open a long position. A stop loss can be placed slightly below local minimums within several candles from the entry point. Close the position at either a take profit level, which is 2 or 3 times bigger than the stop loss, or when a reversal signal occurs, in order to avoid losing money. Okay, now we move on to the fun part. When using the stochastic indicator on Forex trading, there are many signals, including the overbought and oversold levels of the market. That's why this momentum indicator is often used with the other indicators for more accurate signals. So in this section, we will explain the specifics of the stochastic oscillator signal types, methods of interpretation, and detection. So, how do you set stochastic indicator? Usually, the parameters are defined by 3 meanings. One of each, %K, %D, and smoothing coefficient. So 5, 3, and 3 is one of the classic combinations, where 5 is a period of %K, the leading stochastic curve. The value 5 means the maximum and minimums will be calculated for the last 5 candles. 3 reflects the period of %D and a so-called signal line. So it's a simple moving average built on the final parameter of %K. And 3 is the last parameter of the slow stochastic oscillator. It's used to smooth the %K curve, making it more flowing without market noise. So in other words, initial %K is calculated with an averaging coefficient, we could say. So the %D curve will be built on the average value of %K. In fact, it will be double smoothed. Such an effect allows you to filter noise and reduce the number of fake signals, but it also increases the stochastic oscillator's lag. That's why it's called slow. So if you don't want to use smoothing, you should use 1 as the last parameter. Such stochastic indicators are called fast. So the full version of the stochastic oscillator allows you to change all 3 parameters and even how percentage the stochastic is smoothed. I know I will be maybe a little cringe to say that, but of course this is the Light Finance Brokers channel. So I feel a little bit obligated to mention that they, apart from giving you demo account to experiment with, they also provide you the full version of the indicator. And even on TradingView, you will not have those options. So it supports 4 types of smoothing the stochastic oscillator. The simple is classic smoothing and uses a simple moving average, the SMA. Exponential smoothing uses an exponential moving average, which is the EMA, right? Linear weighted smooth using linear weighted moving average, the LWMA. Smoothed is a double smoothing due to the feature of the smoothed MA, which is, of course, a smoothed moving average. And so such functions allow the user to make use of the stochastic oscillator formula in any trading tool and market in order to spot easily the highest and lowest prices of the market when trading CFDs, currency pairs, etc. And so there are no strict rules on what smooth settings to use with this momentum indicator, but it's vital to consider their differences for successful trading experiments. So let's visually compare how they differ. In the case when we trade, for example, Forex, like this price chart, the numbers can correspond to 5 signals of the stochastic oscillator. It's clear that the second and fourth signals are fake. The first and fifth ones reflect the local correction, but the most valuable signal is the third one, which indicates a trend reversal. In some points, protects the trader from losing money rapidly. So what should be noted? Here the signals are a cross of percentage K and percentage D lines above 80% and below 20%. So later we will talk about momentum indicator signal in detail. Now it just should be remembered that this is a condition for the experiment. So on this chart, the stochastic oscillator takes various forms, such as the fast, slow with the SMA, slow with the EMA, slow with the smoothed moving average, and percentage of all stochastic are similar. The percentage K is 5, percentage D is 3, and a smoothing period for all types except for fast stochastic is 3. So conclusions from this example are as follows. A fast stochastic oscillator is a momentum indicator that reacts to the market movements faster than other types. It operates almost without a delay, but the number of fake signals is large, leading investors to lose money. So using a slow stochastic oscillator with SMA and LWMA is almost identical regarding the lag and number of fake signals. The filter of the slow stochastic indicator with smoothed moving average was too strong and suppressed almost all signals. It provided only the last alert out of 5. So the most effective slow stochastic was the one with the smoothed EMA. This indicator successfully filtered fake signals and was slightly faster compared to its counterparts. So we tested the signals on the M30 chart of the Euro-USD currency pair. Still, of course, results may vary on other timeframes and trading instruments. So remember, as I mentioned, you can compare any type of stochastic indicator using a free demo account right now, for example, on Light Finance. Yeah, if you know what I mean. In several clicks without registering, you can open a demo account and you can find it in the link in the pinned comment. So going further, as I mentioned, timeframes also play an important role. So the best, or rather I should say the most popular stochastic oscillator settings for M5, M15, M30 and sometimes even H1 timeframes are as follows. We have 10, 7, 3, 7, 3, 3 or 5, 3, 3 respectively, of course. On high timeframes, such parameters may generate false signals. Therefore, stochastic oscillator settings for H4, D1 and sometimes H1 as well charts are as follows. We have 9, 3, 3, 14, 3, 3 or 21, 3, 3. So you can use slower curves with a 21, 7, 7 or 21, 14, 14. And those are settings for daily and weekly charts. So the described settings combinations are used most often. You can practice and pick your own, of course, parameters, but maybe you will succeed and find a perfect combination for your own stochastic strategy. Okay, now let's discuss crossovers between the percentage K and percentage D curves, which is the leading signal of the stochastic oscillator tool. It's analyzed only in overbought and oversold zones, analyzing the current closing price. In other cases, such signals are useless. So there are two types of crossovers. When the percentage K line curve breaks above the percentage D line, the trend is bullish. In this case, it's worth placing a pending order slightly above the cross point. When the percentage K curve crosses the percentage D line upside down, strong sell signals are monitored, meaning that a bearish trend begins. So a short position should be open slightly below the breakout point. So now I will show you how to use the stochastic oscillator by spotting the overbought and oversold conditions on the Euro-USD chart. So above the green oval, you can see an upward cross of the percentage K and percentage D lines. And since the signal occurred below the 20%, the risk of it being false is low. So here it's worth opening a long trade near the highest point of the crossover candlestick. And so on the chart where the lowest prices are, I marked the entry level with a green line. And so here we observe the opposite situation. A percentage K line curve crosses the percentage D one downwards at a price range slightly above the 80%. Therefore, analyzing the behavior of the stochastic lines, we can open a short position near the close price of the candlestick where the cross happened. At the same time, a small shift down is acceptable. And so, in the chart, this situation is marked with a red oval. Okay, now let's move on with the topic. We will discuss the overbought and oversold zones. So the stochastic oscillator can help the user to have a better understanding of the overbought and oversold conditions of the market. The overbought issue occurs within an uptrend when the main line crosses the 80% level in an upward direction. It's a sign that the rise slows down and the price trend reverses down. Generally, a sell position should be opened when the line breaks the 80% level from the top where the last closing price is and follows a downward direction. Oversold conditions happen in the downtrend when the line falls below the 20% level. And in a similar fashion, it signals a slowdown of the price decline and that there is about to be a reversal. It's recommended to buy when the curve exits the oversold area, crossing the 20% line bottom up. And so when analyzing the indicator's behavior in overbought or oversold zones, it's worth considering the reversals formation in order to spot a potential buy or sell signal. If the primary curve forms an acute angle, the following price movement will be intense. If the repeated break occurs after flat conditions, the move will likely be weaker but more stable. And so using the stochastic oscillator on the chart, blue squares indicate overbought areas, red ones mark oversold zones. In all three cases, three major signals show that the price trend finally to be reversed. So the right blue square displays a sharp turn. It corresponds with the area on the graph marked with the blue oval. And so after the reversal, there is an intense downward movement showing a potential sell signal, offering the trader the chance to understand how to spread bets. And okay guys, that will be all for this video. Stochastic is very interesting and actually I will make a continuation of this in the next one. So stay tuned and I'll see you in the next video. Take care and goodbye.